Just because you use your vehicle for business, you shouldn't automatically assume that it would be better to put the vehicle in your business name. You don't want to pay more in federal taxes simply because you titled your vehicle in a way that works against you. By the end of this video, hopefully you will have more information you can use to determine whether or not you should put a vehicle under the name of your business. I'm not saying that you should never place a vehicle under your business name. I'm just giving you 3 reasons you may not want to put the title of your cars under your business name. I'm not giving you tax or legal advice here, so please consult with your tax advisor to determine what's best for your situation. The first reason that you may not want to put your vehicle in your business name is deduction limit. There's an annual luxury automobile depreciation limit for a vehicle. This limit is the maximum tax deduction that you can take on a luxury passenger vehicle. The IRS's definition of luxury is a vehicle with 4 wheels that is suitable for public streets and has a gross vehicle weight of 6,000 pounds or less. So the price of the vehicle doesn't matter. For 2024, the depreciation limit for the first year is $12,400, and you can take up to an additional $8,000 in bonus depreciation. So if you were to use the vehicle 100% of the time for business, the maximum depreciation that you can take in year 1 is $20,400. And it doesn't stop there, because for each year after the first year, you can't deduct more than the amounts shown in this chart. If you have a lower priced vehicle, you might be able to get full depreciation in 5 years. But in order to reach full depreciation for a car with a higher value, you will have to keep the car for a longer period of time. So the normal depreciation of 5 years could turn into 7 or 8 or more. A lot of people don't keep their cars that long, especially if they're putting a lot of miles on them. By the way, if you finance your vehicle by using floor financing, you won't be able to take the extra $8,000 in bonus depreciation. And wouldn't you know it, most car dealerships use floor financing. I guess it's no big deal though, because bonus depreciation will gradually phase out through the end of 2026. So unless the laws change, after 2026, bonus depreciation will be a non-factor anyway. The luxury vehicle limitation and the annual lease income inclusion is why you will hear tax advisors suggesting that you purchase a SUV, pickup, or van for your business. These type of vehicles typically have a gross vehicle weight over 6,000 pounds, but under 14,000 pounds, so the luxury limit does not apply, and you get a higher lease limit if the vehicle can be classified as a truck for tax purposes. Most manufacturer websites will indicate if a vehicle is classified as a truck. If your vehicle is classified as a truck, you can deduct more. For 2024, the Section 179 limit is $30,500, but the vehicle has to be used more than 50% of the time for business. In addition to Section 179, your business can use bonus depreciation and regular depreciation. Under the SUV rules, you don't have to worry about the bonus depreciation cap of $8,000, but bonus depreciation is limited to the percentage used for business. Also, you cannot use Section 179 upfront depreciation to create a federal tax loss for your business. So the total you can deduct under Section 179 cannot be more than the taxable income of your business. The second reason you may not want to put a vehicle in the name of your business is depreciation recapture. Depreciation recapture forces your company to pay back some of the depreciation that has already been claimed. When your company sells or disposes of a vehicle, and if there is a gain on the sale, the company may have to add part of the depreciation that has already been taken back into ordinary income. Your company could have a gain if a vehicle is sold for more than its purchase price, minus the depreciation that has already been taken. For example, if your company buys a $25,000 car in January of 2024 with a gross vehicle weight of less than 6,000 pounds, and most of the depreciation is deducted in the first year, and if after 3 years the car is sold or traded in for $10,000, there would be a gain. Now, if your business use of a vehicle ever drops below 50% and you took Section 179 or bonus depreciation, you may have to deal with recapture in these cases as well. You would take the difference between straight line depreciation and the depreciation that you actually took, and this difference would be treated as ordinary income. I plan to make a more detailed video about depreciation recapture, so if you want to know more about how it works, please come back later and watch that video. This leads us to the final reason that you may not want to put a vehicle in your business name: personal use. When I was a practicing CPA serving small businesses, and before I worked as an IRS auditor, I never had a client that did not have some type of personal use on a vehicle. If you're not a large business with a fleet of cars, it's unrealistic to have absolutely no personal use on a vehicle. At the very least, most people have a daily commute. As a matter of fact, the IRS has listed the personal use of vehicles as something that is highly abused. The IRS already knows that taxpayers try to claim that personal use was actually business use. Tax auditors are trained to look out for personal use on vehicles that weigh less than 14,000 pounds or vehicles that are likely to be used for personal use. So when an IRS auditor notices that you have vehicles with no personal use, it's an automatic red flag and the auditor will take a closer look at it. If you aren't using your vehicle more than 50% of the time for business, then it may not be worth putting it in your business name, because whenever you have any type of personal use, you will have to pay the company for use of the vehicle. You will have to calculate a value for any personal use. This is called the lease value calculation, and the lease values used by the IRS are more than it would cost to actually lease a car from a leasing company. The IRS provides an annual lease value table that you will use. You will use the same value every year, so the amount will not change from year to year. So as the value of the car is falling every year, you are stuck using the original value of the car. You will choose your lease value from the table based on the fair market value of the car on the date when it first became available for personal use. Then you take the annual lease value plus the actual cost of any gasoline paid for by the company and multiply it by the percentage of personal miles to total miles driven. If your company provides its own gasoline through something like on-site gas pumps, then you would use 5.5 cents per mile for the cost of gas. So let's use our $25,000 vehicle in another example. We will say that the company paid $2,000 in gas for the year and 5,000 miles out of 20,000 miles driven was for personal use. This is 25% of personal use, so you end up with $2,212.50. If you are a corporation, this amount has to be added back to an employee's W-2 as additional income, plus the company would have to pay payroll taxes on this amount. To avoid the W-2 situation, the employee can pay the company back for personal use, but amounts have to be paid back within 120 days of when the expense was incurred. So it would probably be best to reimburse the company at least every quarter for any personal use. If your company is not a corporation, you won't have a W-2, so you will use owner's draw or reimburse the company for your personal use. When it comes to vehicles, if you have any personal use, it will eat away at the benefit of being able to depreciate the vehicle. Here's what I mean. If you take that same $25,000 car, deduct $2,000 in gas, deduct $4,000 in car-related expenses for things such as repairs and insurance, and then add personal use back to income, in year one, it will look like it's better for the company to own the car. Let's take a look at the numbers. To make things simple in our example, we will use the same amount for gas, repairs, and personal use every year. After we take as much as we can for depreciation in year one, you can see that the remaining years are a lot lower. Even if you were to spread the depreciation across all the years instead of taking so much in year one, it wouldn't matter. The total final deduction after 6 years would be the same. Once it's all said and done, when you have personal use on a vehicle, you might end up with a larger deduction by personally owning the vehicle and having the company reimburse you at the standard mileage rate. Another benefit is now the company wouldn't have to worry about depreciation recapture since the company doesn't own the car. You should always run the numbers for your situation though, to see what will give you the highest deduction. There are other methods that you may use to calculate personal use, such as the general valuation method or the cents per mile method. These methods usually result in even more that has to be added back to income, or there are all kinds of qualifications that might prevent your company from using the method. Ultimately, if you decide that it's better to put the vehicle in your name instead of in the company's name, please remember that you can have the company reimburse you for using your vehicle. If you are a corporation and you want to reimburse employees for vehicle expenses, you would need to use an accountable plan. Please watch the video in the upper right of your screen if you want to learn more about an accountable plan. As a business owner, if you want to know more about how mileage should be recorded, please watch the video on the lower right of your screen. The video is for gig independent contractors, but it's also useful for any business owner using their vehicle for business. See you next time.